Michael, thanks for your time today. The bank today has released an update for the first quarter and it shows that performance is on the up, although margins, there is some pressure there. Can you talk to us about what some of the key drivers are behind the result?
Certainly, yes. We've made a solid start to the year. Our reported financial results were up strongly, and when we take out notables, our cash earnings were up about 1%, which is a good outcome for the quarter. When we look at the key drivers, firstly, we had a strong markets and treasury result as a result of increased customer activity and a lot of volatility in the market, which gives us an opportunity to create some revenue. Our loan balances grew $5 billion, which was pleasing. Also, we reduced costs by 7%, which is a great outcome, and so the outcome of the simplification work that all our businesses are starting to undertake.
And on costs, as you say, there has been progress there, but you're also announcing today some structural changes to help speed that along a bit. Can you talk to us a little bit about that, and also whether you think those changes will also lift confidence in the bank's ability to deliver on its $8 billion cost target?
Yes, as you say, we committed to our $8 billion cost target at the 2021 financial results, and part of that cost target, we indicated that we would create a smaller head office to reflect the simplified organisation that we're creating. We're exiting a number of non-core businesses and they're progressing well. We're simplifying our business through automation and digitisation. And thirdly, we're creating a simpler organisational structure to reflect that simpler business structure. And we indicated that a head office simplification was part of that, because, and so this is simply the outcome of the work that we indicated.
The structural change does come off the back of a period of quite a bit of change across the organisation, as you've pointed out. Is change fatigue amongst staff something that concerns you at all?
Yeah, I must say, when I think about where we've come from, there's been significant change over the last 2 years. We've obviously had the disruption from COVID and the various waves. The financial services industry has come up with a lot of disruption and a lot of change, originally brought about by the Royal Commission, but also issues that Westpac has faced into. So our people have undertaken a lot of change over that period of time, and we're very conscious of that. But having said that, the financial services industry continues to change rapidly, and we need to get into a habit of responding to that. And this I see as part of that. So we acknowledge that this is further change that does impact our people. But I'd have to say, our people have responded really well. And what we see time and time again is that, we are responding well to customers. Customer complaints are down. So we're seeming to manage through this period of change and look after our customers, which is great.
Turning to margin, competition, particularly in the mortgage market, has put pressure on the margin. Are you expecting to see that pressure continue into the year? And also, what kind of upside have you factored in as we enter a period of higher interest rates?
Yeah, I've been in and around financial services for many years. I won't say how many, but this is probably the last 12 months to 18 months has been the most significant competition on rates in the mortgage and small business market that I've ever seen. And so, as we came into obviously slower growth in the economy, the Reserve Bank lowered rates, and we saw a big pickup in housing prices and activity. And the number of players in the market have just meant that price competition has been at unbelievable levels, and that is the key driver of the reduction in our margins over that period of time. I can't really comment about where we see it. There's a lot of speculation in the press about the Reserve Bank and when they're raising rates, and Westpac Economics is now saying that they expect rates to rise later in the year. So we'll have to see what happens and how the market will respond. But all I would say is that I expect that level of competition to continue. So our challenge is, how do we respond to that from a customer perspective? How do we make Westpac a great place for people to bank and want to make us their main bank? So that's our challenge, and the market will play out, I think, over that period of time.
Okay, and turning to COVID, another big factor.
Yes.
The bank has increased provisions, which reflects ongoing certainty around the current wave. Can you give us any insights into the impact that you're seeing from the Omicron strain?
Yeah, no, it's been quite interesting. I think that as we've seen going into COVID, the original tranche of COVID, you know, we saw quite significant increase in stress in the portfolio, and our provisions went up. And then when we got through the first couple of waves, we've actually seen a continuing improvement in the underlying portfolio. Delinquencies are down, stressed assets are down, and while a lot of our customers in specific industries have found it very difficult, particularly those that are in hospitality, you know, and particularly in the CBDs, really struggle with lower business. But what we've seen is, you know, our customers have been surprisingly and pleasingly very robust. As we came into Omicron, with the Omicron wave towards the end of last year, though, what we started to see was some sort of some stress in parts of the economy. So we saw some construction issues, particularly residential construction, come under pressure with supply chain changes. We saw an increase in inflation, and those sorts of things were playing through. And so we just thought we would be prudent and put some overlays on our provisions as we came into that, just to make sure we were well provisioned going into the result.
And on the economy more broadly, so we are in a new year, but we are in the third year of the pandemic. How are you feeling about the economic outlook for the rest of the year?
Yeah, I think what we saw coming up before Christmas, you know, in that rise, before sort of the Omicron wave really hit, we saw a really good increase in consumer sentiment, in business sentiment. We saw consumer spending growing quite strongly. We saw card balances grow for the first time in a long time as people started, you know, to really spend some money. And then coming into Christmas, that really fell off because of, you know, people were concerned about Omicron. But coming into 2022, we're reasonably positive around economic growth. Westpac Economics is forecasting more than 6% GDP growth this year. You will have seen, you know, the expectation now is that unemployment will dip below 4%, and that'll be the first time in a lot of people's living memory. And so the fundamental settings for the economy are strong, and that augurs well for our business.